Hey everyone, in this video I'm going to take a look at Google stock and do an intrinsic value analysis using a discounted cash flow model. As a humble servant to the Google overlords and their platform of YouTube, may it live forevermore, I feel obliged to take a quick look at the stock since it is one of the most powerful companies in the world and certainly one of the most profitable. They have a pretty wide array of products. I'm certainly a user of many of them and you probably are as well, especially if you're watching on YouTube right now since that is owned by Google, and they continue to throw off increasingly massive amounts of cash flows. But before I go any further, do realize that this is not specific advice for your own portfolio. It is up for you to decide whether or not you want to invest in a company like Google or invest in anything for that matter. It's up for you to do your own due diligence because no one can make that decision for you. So please do your own research and consult with a licensed financial professional if you feel like you have to, because I am not one of those. Anyways, let's get into it. Here is Google's stock chart. We're at a 1-year view here. They're up 30%, almost 31% over the last year, at least as of recording this. By the time this releases, who knows what'll happen because the market's volatile, but Google keeps trucking along in an otherwise pretty rocky market for a lot of especially tech stocks, or at least those stocks that have been pretty heavily reliant on future growth projections. Google would seem to fall into that boat, but they've continued to truck forward. But at a current share price of just over $2,700, that puts them at a market cap of $1.8 trillion. So a massive company, one of the biggest in the entire world by quite a long shot. So we're already dealing with a pretty unique company here just by size alone. This is a massive company. But let's go ahead and take a look at the financials. It's one of the first things I like to do. And specifically, let's take a look at the balance sheet and see what they're working with. They currently have around $140 billion in cash and short-term investments. Yes, we're talking about billions here. Lots of money being thrown around, but this is just their cash pile. Let's go ahead and compare that to their debt. And they've currently got just under $13 billion in long-term debt, which is nothing compared to that cash pile. If we go ahead and add on capital leases as a sort of long-term debt, we're looking at something like $25 to $26 billion in long-term debt. So they could very easily pay down their debt just using their existing cash pile many times over. But let's go ahead and scroll on down to total shares outstanding. That is a big problem with a lot of tech companies in particular, ones that are growth oriented. There's usually a lot of dilution where they're issuing more shares, but we are not seeing that with Google. They throw off a ton of cash, so they actually are buying back shares, or at least they have been over the past few years. And when a company buys back shares, that means that there are less shares outstanding. And when there are less shares outstanding, each existing shareholder now has a greater share of the overarching business, a greater proportion of the business, all of its profits and all that good stuff. The opposite is true when a company issues new shares. That's called dilution. When that happens, there are now more shares out there, so each individual shareholder now has a lesser share of the overarching business. It's very much like inflation, but in this case with the number of shares outstanding. But Google definitely does not have a dilution problem. Instead, they've been buying back shares at a pretty respectable clip over the last few years. So that's a quick look at the balance sheet. Let's go ahead and take a look at their top line, looking at the income statement. Let's see what's going on with revenues. Let's go ahead and graph it here. And boy, that is some pretty hefty revenue growth. This is just over the past 5 years, but they're up to just about almost $260 billion in annual revenue. This was in 2021. And that's a pretty big jump off their 2020 revenues, which were more like $182 or $183 billion. This was back in 2020. So revenue growth has continued to be pretty strong, even though it did dip a bit in 2020 down to only 13%, but off a very big base. But 2021 was a spectacular year for their top line where they grew 41%. Revenues grew by over 40% already off of $182 billion all the way up to almost $260 billion in annual revenue for 2021. Just insane growth for an already huge company. And being predominantly a software business, their margins have remained quite steady even as the company has continued to scale, looking at something like mid-50s to high 50s for gross margin, at least during the last handful of years. So the top line is looking pretty great, but what about cash flows? Pretty much any company can blow out spending to increase revenues, but if it's not getting out to their profits at the very end, then what good is all of that spending? So if we go on over to their cash flow statement and go on down to cash from operations and subtract capital expenditures, this gets us what's called free cash flow, which is essentially the lifeblood of the business. This is all the money that's left over after all their expenses. And this is the money that a company can use to reinvest into itself, pay dividends, buy back shares, and do pretty much all the nice things that a business owner is looking to get to at some point, at least over the long term. You want these sorts of things, and you can do that with free cash flow. And my goodness, would you just take a look at this free cash flow growth over the past few years? We've seen capital expenditures remain pretty steady in the mid-20s, mid-20 billions, but look at cash from operations just continue to go up and up to where in 2021, they had free cash flows of around $67 billion, which was a sizable increase from the already hefty cash flow in the previous year of something like $40 billion back in 2020. So free cash flow, rather unsurprisingly, is massive for Google. The question is, what can they grow it to? And that's the question with pretty much any company. What happens next? Hey guys, real quick, if you haven't already, be sure to check out M1 Finance. It's the stock platform that I use for most of my holdings, and I always do an update on my M1 Finance portfolio every single month. So if you haven't seen that and want to see what the platform looks like, go ahead and check that out. But I always include an affiliate link in the description below. Appreciate it if you check it out, since it is a really nice brokerage. And if you end up funding your account, it would go a long way towards helping the channel. Now, before we make any guesses on what Google's growth might be, let's try to get a better feel for what's actually going on with the company. Here is a graph showing their distribution of revenues between all of their different segments. And you can see that the vast majority of their revenues over the last few years, it's been pretty steadily, heavily leaning towards their ad services, which makes a lot of sense. Google obviously is a search engine first. That's how they built their business. They have YouTube as well, which effectively is a search engine for videos. And with all of that, they're driving a ton of traffic towards specific content. And in driving that traffic towards things, they place ads in front of people. So it's a really simple model in that way. But when you have massive amounts of traffic, you can get some pretty hefty profits. As we've seen, we just looked at their financials. Just because a business is simple doesn't mean that it can't be extremely effective. And with the amount of search traffic and volume that Google sees, they can tailor those ads pretty effectively towards whatever that target audience is. They have a mountain of data at this point, and it's only getting bigger by the day. So if you're looking for a company moat and you're not too concerned about data privacy concerns and potential regulations against things like Google and other data-oriented companies, then this arguably is about as clear as you can get. It's going to be very hard for any company to come in and just push Google to the side because they have so much data. They've created such a good product for getting ads to people, and that does help to explain why their gross margins have remained so steady even as they've continued to scale to huge levels. But anyways, beyond ads, they also have their cloud services division, which certainly throws off quite a bit of revenue. And then they have a bunch of other things. And you could argue that this could be a pretty big engine for growth, even if things slow down on the ad front. But again, they really are an ads first business. And being such a high margin service, it seems like it'd be pretty hard for anything but ads to continue making up a very huge portion of Google's overall revenues. So they're always looking for new opportunities, both in and around their ad services base. And just one quick thing I'll mention, there has been some news recently about the stock split that they'll be doing in the coming months. This means that Google's effectively going to be chopping their shares into multiple smaller shares. Do realize that this doesn't change anything fundamentally about the company. So when we're looking at revenue splits and all that sort of stuff, that doesn't change. What changes is just the share price itself. The shares are chopped up into more smaller pieces, but the overarching business remains the same. A lot of people, for whatever reason, get really caught up with stock splits as though there's some magic pill. And you see often stocks go up on the announcement of a split. At least recently, that seems to be the case, at least for a lot of these bigger companies, which is kind of crazy just considering that doesn't change anything fundamentally. You can make an argument that it changes things like options pricing and that sort of thing. But there is this argument of accessibility where if you make the share price smaller, then more people theoretically can afford it, even though a lot of people have access to fractional shares now, or they invest through things like mutual funds and index funds. So you're getting a pretty large share of Google at this point anyway, since they make up such a large portion of the market. But I thought I'd go ahead and mention it here since it's been in the news. So let's go ahead and attempt to calculate an intrinsic value for Google using this discounted cash flow model. So I'll go through our input factors here right now. So we have a year zero cash flow of $67 billion. For this first example, we're using a 15% growth rate and a 7% growth rate. I'll get back to that in a second. We have our discount rate here, which effectively discounts our assumptions over time. And what this would mean is that if all of these assumptions came true and things were priced according to this model, then I would expect at minimum a 15% return on average over the years. You can obviously change this discount rate as you see fit. I'm using a terminal multiple of 15, which multiplies our year 10 cash flow in order to get the terminal value of the business. And then we have an excess capital number of 113 billion, which takes the cash and short-term investments minus the long-term debt and capital leases for this example. So we take our year zero cash flow, multiply it by the growth rate, growing those cash flows over the 10 years. We take our year 10 cash flow and multiply it by the terminal multiple of 15 to get our terminal value here. We then discount all of those cash flows using our discount rate, including the terminal value down here. We add up all of those discounted cash flows to get a present value of future cash flows of $1.3 trillion. We then add on our excess capital number to get us an intrinsic value of $1.420 trillion. And if we compare that to the current market cap of about $1.8 trillion, that would imply a margin of danger, the opposite of a margin of safety, of 21%. Now let's take a look at what's going on with these assumptions. This 15% growth rate, you might be saying, hey, wait a second, they just had 40% revenue growth last year. They are growing like crazy. Why can't this growth rate number be higher for these next 5 years? And you certainly could do that. I mean, you could do whatever you want in your own financial model, but let's see what this 15% number in the first 5 and then the 7% in the next 5 really gets you at. Because if we fast forward to year 10, that would imply that their year 10 free cash flow would be $189 billion. That's in just 1 year, which is well over double what they're doing right now. And what they're doing right now is already incredibly huge. So could they really get to this number? That implies that the business would be worth $2.8 trillion just based on this specific model. It could be worth more or less, but in any event, you're still getting to that $189 billion in annual free cash flow. $67 billion in annual free cash flow already is kind of an unfathomable number, but now we're getting it all the way up to $189 billion. So how reasonable is this assumption? Could they do it? Sure, of course, anything is possible, but how likely is this really? Well, let's say you still think the growth rate is going to be much higher and that they're actually going to have, 25% growth rate over the next 5 years. That would imply that they're getting up to $286 billion in annual free cash flow at the end of year 10. And that is still with only the second set of 5 years being at 7% free cash flow growth. So significant growth still, and we're getting all the way up to $286 billion if you're using that 25% base for the first 5 years. And again, is it possible? Sure, but again, we're talking about what's likely here. And if we're trying to be more conservative, maybe we bump this growth rate down to 7% for all 10 years. So still pretty significant growth considering where they're starting from. And that would imply that they're still well over $100 billion, $131 billion in annual free cash flow at the end of year 10. And maybe they get there, but that implies that you're definitely overpaying for the company if you're to believe these assumptions and you're using a 15% discount rate. And even if you play around with this terminal multiple here and say it's closer to 20, say 18 rather than 15, it's still not getting you to that number that you really need to be at using that 15% discount rate and these other assumptions. I tend to use 15 because that's more in line with a lot more historical averages when it comes to free cash flow and earnings multiples. When we're talking about the broader stock market, sure, every company is going to have different multiples because it largely depends on growth. But in this case, I'm assuming Google is a pretty mature company at this point, doesn't have as much room for growth at the end of 10 years. So I'm using 15 rather than say 25 or 30, which would imply that there's more growth ahead. Of course, you can change this as you see fit. And for me personally, I would want to buy Google at a price where it really wouldn't need to grow much from where it currently is, because I really don't know what this thing is going to grow to. It's already humongous. How much more could they possibly get to? I'm sure I'm going to eat my words and they're going to just triple or something over the next 2 years or something ridiculous, but who knows what will actually happen. But I want to get it at a price where that doesn't need to happen, where it doesn't need to grow 20% per year for a number of years just to reach fair value today. Because the more you pay for a company, the more you need to go right over the long term to actually justify that valuation. And when you need more to go right, you have more room for error. So by no means am I guaranteeing that Google couldn't reach some amazing growth rate over the next 10 years. They certainly could. They have shown that they've done it over the past few years. Maybe they continue to do that. Maybe they find new avenues for growth. They find ways to improve revenues even more, improve cash flows downstream. We'll see what actually happens, of course. But again, I want to buy the company so that a lot really doesn't have to go right for my own investment to turn out well. But as with all things investing, beauty is in the eye of the beholder. We're trying to tell the future here, and that ultimately is impossible to do. So it's really just a game of probabilities, and that is totally up for you to decide what those probabilities really are. So for now, even though it clearly is a fantastic business throwing off huge amounts of cash flow, I am not going to be buying Google stock, at least at these prices. We'll see what happens though. A lot can change in just a matter of months. We've seen that with a number of even large companies recently that despite throwing off huge amounts of free cash flow, people have not liked their forward guidance for whatever reason. And that's where the opportunity might come in, where the market sentiment is down on a particular stock, even though the fundamentals remain great. And you still think that they can maintain that great growth or whatever assumption that you need to happen in order to meet your investment thesis. But in any event, as my obligation to the YouTube gods, I need to emphasize that Google is the most wonderful company in the entire world. Its stock is fantastic. It's the most amazing thing ever. I think everyone in the entire world should own Google stock. And by extension, every single person on the face of the earth should be watching YouTube 24 hours per day, even while they're sleeping, so that we can continue to drive more great ads towards the people that really need to see them most. That's what it's all about. That's why Google is such an amazing amazing company, amazing brand. YouTube especially is another amazing product. It's just so great. And if the YouTube gods could just send me a few million subscribers, just a few, that would be so excellent and would really go a long way towards helping this fantastic platform. But anyways, if you like this video, please like it, since that would help the channel out a lot, and be sure to subscribe since I put out new videos every single week. But until next time, take care.